Oil continues to gradually gain value. However, its upside momentum is not as strong as it was during the start of the conflict between Russia and Ukraine. Watch our video review to find out the reasons for such dynamics and the outlook for oil, gold and ruble quotes. After fears about a possible ban on Russian oil and gas imports eased, market participants switched back to the threat of a looming oil supply crisis. Unfortunately, the risks of this scenario have just increased, which contributes to a rally in oil prices. After several days of drifting around the psychological level of $100 per barrel, Brent crude oil futures finally decided on the direction and bounced up. The asset gained more than 12% in just 24 hours. As a result, the benchmark approached the mirror level of $110, but then slowed down. Thus, if the price consolidates above the 110 mark on the 4-hour chart, it will most likely continue its bullish run. Until then, the risk of a pullback remains. As for the Russian currency, the situation remains unchanged. The ruble is trading in a slight uptrend thanks to sanctions. More precisely, this stems from the reluctance of the United States and the European Union to adopt further targeted restrictions. As soon as the US Treasury Department said that the current sanctions did not stop Russia from paying bills, the Western media stopped talking about a default on Russia's sovereign debt. Against this background, wild fluctuations in the Russian currency somewhat reduced. However, when trading on the Moscow exchange closes, the quotes moves become erratic again. In the interbank market, the quotes once again traded below 90 rubles per dollar. Apparently, some market participants consider the rate above 100 rubles to be excessively high. Therefore, it can be assumed that in the medium term, the exchange rate will drop closer to the mark of 90 rubles per dollar. As for technical analysis, it's still irrelevant under such market conditions. Gold seems to get stuck in a narrow range. However, it will be too difficult for the asset to maintain stability. Amid global economic turbulence and the Fed's plan to tighten monetary policy, gold will most likely continue its swings. As the scale of an economic downturn will become clearer, interest rate hikes in the United States will have a greater impact on gold quotes. Thus, the medium-term outlook for gold is rather gloomy. An increase in the Fed benchmark rate will contribute to the transfer of capital into US public debt. So, part of the capital will definitely flow from gold to Treasuries. After bouncing off the $1,900 support level, gold futures climbed by about 2.5% and touched the variable resistance level of $1,950. To extend gains, the price needs to consolidate above the resistance level of $1,950 on at least the 4-hour chart. Otherwise, the volume of short positions may increase. You've watched Daily Financial News on Insta TV with me, Anna Kasatkina. Stay tuned.